Hey, what's up YouTube? This is Leo with DRIPCalc, and I want to talk about inflation today. So they tell you that inflation is easing and that it's below 3% now, and Jay Powell says that it's transitory, and then it goes up, and now he's saying the time has come to cut the rates because we take control of the inflation. And when you look at all the media talking about inflation and also some YouTubers, now I won't name names, I will include one clip of a guy that was actually right on the direction of the market, but they don't take into account the reality.
Hey guys, it's Sasha. The latest US inflation data just came in, and inflation went down slightly to 3.4%, up 0.3% month on month. There are two big problems with this inflation data. The first big problem is that the real level of inflation in the US right now is at 2.6% or thereabouts, and there are only really two major factors that are keeping that rate above 2% in the first place: high energy prices and high car insurance. Both of these are high not because of a systemic inflationary pressure pushing them up, not because of some fundamental serious problem, but because these sectors are busy profiteering under the guise of inflation. I'll explain all of this in some detail. And the second big problem with this inflation data is that a lot of Tweedledums on the internet will keep shouting that inflation is sticky, it's a big problem. Oh no, the media loves to do this, and real estate agents with small peepees do it because panic sells. When your channel dies, nobody wants to go and watch your videos anymore. The only thing you can do is shout loudly about stuff you don't know anything about.
Alright guys, I gotta give it to Sasha. When I watched one of his videos like a year and a half ago, he was actually directionally right on the market. The market took off like crazy, and we know that S&P 500 has been up like 40% since beginning of 2023. But he sits in England, I take it, and he is talking about American inflation, and we don't know anything about it. Well, guess what? Our stuff is super expensive. But even more annoying, like this guy, you know, I actually like his videos. But what's more annoying is Jerome Powell. Like over here and over here, he was saying inflation is transitory, meaning it will pass. Like, yeah, it went up a little bit, but it will go away, it will drop down. Meanwhile, they were printing trillions of dollars of money out of thin air and distributing part of that money to the population, you know, like, yeah, go buy yourself stuff, you don't have to go to work. And that was about $2 trillion. But then the other $5 trillion, they kind of distributed between themselves in a different manner. And he's like, inflation is transitory. But now he comes out during his speech at Jackson Hole, and he laughs about it. He is like, and the whole crowd at Jackson Hole, they're all laughing about inflation being transitory. Check this out.
Enter inflation. After running below target through 2020, inflation spiked in March and April 2021. The initial burst of inflation was concentrated rather than broad-based, with extremely large price increases for goods in short supply, such as motor vehicles. My colleagues and I judged at the outset that these pandemic-related factors would not be persistent, and thus that the sudden rise in inflation was likely to pass through fairly quickly without the need for a monetary policy response. In short, that the inflation would be transitory. Standard thinking has long been that, as long as inflation expectations remain well anchored, it can be appropriate for central banks to look through a temporary rise in inflation. The good ship transitory was a crowded one. With most mainstream analysts and advanced economy central bankers on board, I think I see some former shipmates out there today.
But anyway, so they say the inflation is getting better, and nominally it is true, but they ignore the reality behind the inflation is that the prices already gone up, and now that we have what they call a low inflation, the prices don't increase as fast as they used to.
We're back now with breaking news on the state of the economy this morning.
The Labor Department has released the latest consumer price index report, and it shows inflation continuing to improve. Consumer prices rose 0.2% month over month in July and up 2.9% year over year. So breaking down what those numbers mean for us, we are joined by NBC News senior business correspondent Christine Romans and Investopedia editor-in-chief, friend of the show, of course, Caleb Silver. Good morning to both of you, Christine. I will start with you over at the big board for us. Break down the numbers for us. What do we need to know? What's the headline?
This is exactly what we wanted to see, quite frankly. We wanted to see, sorry, my board, there we go. We wanted to see these kinds of numbers. 3% was what it was in June, and now you've got 2.9. That is the smallest annual increase since March, early 2021. So that is some important improvement here. This means that big turn is happening. You are starting to see, this was 9.2%, 9.1%. That was a really horrible feeling in terms of wage and price pressures really in the economy. And now you've got a year here where you finally have broken down below 3%. So this is good news.
Caleb, your first impressions, what stands out about this?
So we have a saying in finance and economics, the trend is your friend. So look at the trend for the past 6 months, and it just kind of keeps going down and to the right, and that's what you want. We're not getting deflation. Things aren't necessarily getting cheaper, except for used cars and trucks, but we're getting a smaller and smaller price increase every month, and some things are actually a little bit less expensive than they were a few years ago, but not things like car insurance and rent and electricity. But a number like that shows a normalization of the economy, and that is just what we want.
And we'll take a deeper look at that. But here's a chart of basically inflation since before COVID and ending in 23. Now we have an average of about 3.1% in 24. So before COVID, inflation was 1.23%, and then first year of COVID in 2021 it was 4.7%. Then it shot up in 22 to 8%, and 23 was 4.1, and now it's 3.1. Great. Okay, we have only 3% inflation. And here's the monthly numbers. So this is BLS.gov. This is Bureau of Labor Statistics. So the nominal inflation reported by the by this bureau that actually just came out with revision to the unemployment numbers, and all of a sudden we lost 800,000 jobs because before they underreported the unemployment. Anyway, yeah, almost 1 million jobs disappeared because of the reporting. But anyway, so I want to talk about what this really means for people, what the inflation actually means for people actually having to pay the bills. So I've done some calculations. These are the official inflation numbers right here, 2020 through 2023, and in 24 we have, like you can see over here, an average of 3.1% inflation. Okay, so I put to 3.1 over here. Let's make this all bigger a little bit. So in this column B we have annual inflation. Now this is the value, inflated value of $100. Okay, so and it starts at 2019 because we gotta have a benchmark. Okay, so in 2020 the value of $100 would become $101.23, then 106, 114 and a half. In 23 it would be like 119, and today the value of $100 would be almost $123. Okay, that's with the inflation, with the official inflation numbers. Okay, and here's the compounded inflation, and so in 5 years it's call it 23% over 5 years. Okay, but here in this column we have the value, the real value of your $100. Okay, and so you can see this column is actually decreasing. And so if you could buy something for $100 in 2019, now if you kept that $100 in your savings account, you can only buy $77 worth of stuff, and you basically lost $23 to the inflation. Okay, and now this is with the official numbers, and if we project future inflation at only 2.8%, because the Fed's goal is to keep inflation at around 2%, it's up and down, but let's call it 2.8. So by 2030, so in a 10-year run, the value of $100 would turn into $55. Okay, now that's official inflation, and we project pretty low 2.8% going forward. Okay, but now the more realistic inflation is here. I added 25% to the official numbers, and you can see right here. So I multiply the official number by 1.25, so that adds 25%. And so now, and that's more realistic because the stuff actually gets a lot more expensive for people who actually have to buy stuff. And also consider that your salary or your wages do not go up as high. Okay, and so now by year 24 you lost almost 30% of your value, and so $100 turns into $71. Okay, and a more extreme case, and I'll show you why I actually ran it, it's even probably more realistic case. And so basically here we multiply the original inflation by 35%. So I think the actual real inflation is about 50% to 100% higher than the official, but this is a mere 35%. And so with that you lose almost 32% of your money due to inflation in just 5 years. Okay, so that $100 would turn into $68, and then by year 2030 it becomes $35. Okay, and to demonstrate this, let's go to home prices. All right, so here we have the official home prices from the Fed. You can see right here, median home price. Let's take a look at 5 years. So before COVID it was 321, and we take Q1 numbers over here, 329, I mean, right here, Q1 of 2020, 329, and Q1 of 21 was 313. Okay, so that's our benchmark. And so then Q1 of 21 is 355, which is what we have right here, and so on and so forth. Okay, these are the official Fed numbers. So again, we have the average home price in this column right here. Then we have the inflation, and we calculate the inflation by comparing it to a previous year. Okay, so 5.1% home price inflation between 2019 and 2020. Again, keep in mind this is before COVID starts. Okay, the next year, 2021, we have 7.9% inflation, and the way we calculate it is comparing these two numbers. So this is annual inflation. Then by 22 we have 16% inflation in home prices, and then in 23 we supposedly have only 3.87% inflation, and in 24, latest data that we have so far, Q2 of 24, actually let's look at max. Yeah, Q1. So 26.8. Okay, so we actually have a drop in home prices, supposedly. But the compounded rate of inflation, basically from 2019 until 2024, is 36%. Okay, guys, take a look over here. The federal official numbers are 23% compounded inflation. Compounded meaning combined over time. So inflation on top of inflation. So the way it works, for example, I'll give you a very rough number so you can actually see what it means in reality. Okay, so we have $100 and let's call it a 10% inflation. $100. Come on. So call it number. Okay, and we have 10% inflation. And so let's call it. Let's change this to number. 10%. Okay, so we have equals this times that. Okay, you have $100, $110 after 1 year. Now we project this here, but take this equals that. Okay, come on. And we add a couple of more. So 1, 2, 3, 4, 5. Let's delete this. Sorry guys, I'm doing this on the fly, but yeah. Okay, so we have continuous 10% inflation over 5 years. Okay. However, and you would think that's 50% inflation, but over here you see it's 61.5% inflation. So we subtract 100, the initial 100, so that's 61, and that's compounding. And if we add another 5 years to that, so you would call it you might call that 100% inflation because it's 10% per year, right? But in reality, it's 160% inflation because that's compounding. So you basically inflation on top of inflation, and you can see this right here in the second year, where 10% of 110 is now 11 and not 10. Okay, and so that's why how we get compounded inflation of 22.88%. So it's you're not adding these numbers stack up. That's compounding. And so we have 36% inflation in the housing market. Okay, that's all great. But if you look at Case-Shiller index, basically from before COVID, it's up almost 50%. So it's not really 36% as the Fed puts it over here in the median home price in this chart. Okay, the reality, the Case-Shiller says that it's about 50% increase in home prices in less than 5 years. So that's ridiculous, right? Well, basically the Fed is lying to you, but the reality is that yes, the inflation might be slow right now, but the prices have already increased so much. Like what you could buy in 2019 for $100 realistically now costs you $130, but in reality it probably costs you a lot more. It's probably $150. And let me show you some some anecdotal evidence. So I buy a lot of stuff. I have a bunch of kids, they eat a lot, and these are my receipts from Walmart. Let me make it a little bit bigger so you can see better. And I basically highlighted the stuff that I will give you as an example. Okay, so this is June of 24, so just a couple months ago. Now is August, so 2 months ago, 2.5 months ago, I was buying eggs, 60 pack, so 5 dozen of eggs, large, for $9.32. Okay, 2 months ago. Then when is this? This is June 11th. So another one. Yep, $9.32. Here I bought 2 of them right here. Okay, $9.32. So let's keep going down. So this is May. In May, so a month before June, they were actually a little bit more expensive. They were $11.06. Let's keep going down. And this here is April. They were $14, $13.97. So wow, disinflation, right? Let's keep going. This is April again. They were $12.52. Okay. Okay, I'll come back to this receipt later because this is from 2021. But basically, oh no, this is also from 21. So yeah, basically between June and April, they jumped between 9 and 14 bucks. And if you look at these numbers, it seems like, wow, it's getting more expensive. I mean, it's getting cheaper. They're lowering the prices. But hey, guess what? Then in June, at the end of June, and I don't have a receipt, it went up to 16 bucks. And now, again, this is Walmart. I'm not sure you can see on these receipts. Yeah, see, this is Walmart. Right here, 932. Okay, so let's go to, right now, they are, boom, boom, 18 bucks. So a couple weeks ago, they went from 16 to 18 bucks. And here is 1 dozen of eggs. So, just so you understand, that's $3.60 per dozen. Okay, because here's the unit price, 30.5 cents. So 0.305 times 12, we have 366 per dozen. And here you can buy 1 dozen for 377. And this is, guys, today's prices. Now, I stopped buying them at 374 in the cardboard, and that's what I used to buy. So I stopped buying it in Walmart, and I started buying them in Costco. But even in Costco, they went up from 12 bucks to now almost 13 bucks, and they will keep going up. So let's keep scrolling down, and now we have 2021 prices, so 3 years ago. Okay, Coke was $1.12. Recently, Walmart dropped prices on Coke from like $2.76 to $1.96, so it went down by 80 cents. But hey, guess what? In 3 years, it went up by about 75%. So yeah, great deal. Next, over here, I was buying this mayo. So this is the squeeze bottles. The 22s are the squeeze bottles, and these are the big bottles, big cans, jars, whatever. Right now, it's $5.88, so that's almost double. And this one is up 60%, 66% over here for the squeeze bottles. This is the 22, and the olive, for some reason, is $1 cheaper, so that's $5, still 66%. And the squeeze bottle is also $5. And again, here I was buying them for $2.98 for the longest time. And here the Coke was $1. No, the Coke is $1.96. When is this? 21. Okay, so the price of Coke goes up and down. And here are the eggs in 2021. This is October 21. So 3 dozen of eggs, it is $4.80. So that's $1.60 per dozen of eggs. And now they're $3.66. Okay, I wasn't buying 60 packs back then, but still, it's about the same price. $3.66 now, and I was buying it for $1.60 per dozen. And basically, guys, they're telling you that inflation is 3%, but the reality is that that's 3% up from a year ago prices. And a year ago prices don't really change. They're super expensive. And you can see here, $5 for a squeezed jar of mayo. A dozen of eggs, almost $4. And now, guys, it was even higher at some point, because when we had the chicken egg crisis a year ago or so, like 2 years ago, and since then things have come down, but for some reason things are picking up again. And now I'm not blaming Walmart in this case. In fact, like, well, first of all, Walmart changes prices on their merchandise all the time. It's kind of annoying because now I will not say that they do it on purpose, but when you pick up merchandise, you see a price tag, you bring it to the register, and it rings up at a much higher price. Okay, like for example, I buy avocados, it's like $3.50 a bag, something like that. I bring it to a register, it rings at $6.50. Like, what the hell? And the reality is, what I do is I actually take pictures of the items that before I buy, of this price sticker, because every time I go, every time I have to do a price adjustment. I have to call somebody over, they have to do price adjustment. It's really annoying. So you know, Walmart can say that basically, yeah, this you know, the price change in the system so rapidly, our staff doesn't have enough time to go and correct it. But I think they say that, and part of it is true for sure. You know, like, they change prices so rapidly that workers do not have time to, or forget to update the actual price stickers on the shelf. But they also use this technique, and this is my opinion. I'm not claiming or accusing Walmart to do it, but basically a lot of people, and most people, won't fight. They won't request a price override, and they'll just pay a higher price. And this way, Walmart, you know, you think you're buying something for $1, but then at the register it's $1.50, and you're like, oh, whatever, 50 cents, I'm not going to fight it. Now, I make it a point to fight it every time. It's really annoying. And even like one time I made a guy come over for like 10 cents. But like, out of principle, I will do it. I really hate doing it, guys. Don't think that that I enjoy doing this. Not at all. But it's a matter of principle, and so I do it. But most of the time, it's like every other item is mispriced at the register. So bottom line, things are getting more expensive in like for people who actually have to buy stuff, and people who actually know the price of gallon of milk and the price of gallon of oil and so on. And they tell us that inflation is 3%, but we're already paying like 50% more than we did just 5 years ago, and that's at least 10% a year inflation. So they might be telling us life is good and we'll take care of you, but this whole narrative is false. The prices are getting more expensive, and they have gotten expensive, and so basically the inflation rate is on top of what you're already paying right now. So your inflation rate of 2.8%, for example, is from this point, not from this point. And that's a lot of there's a major disillusion that you think, well, it's only 2.8%, like 3%, yeah, and you think that it's from 100. No, it's from this updated, from the latest price. And I think that why I'm saying that Fed is actually lying about the inflation, because everything is up. Like, for example, the cost of electricity, I'm not even talking about California, I'm talking about my state. So in 21 it was 18 cents, and now it's about 40 cents per kilowatt hour. That's more than 100% increase. And guess what, guys? In my state, most of electricity is produced with natural gas, and natural gas is at multi-year low. Alright guys, so here I have a chart of natural gas prices. So this is dollars per million BTUs. It doesn't really matter what that means, but basically 1 million BTUs is 10 therms, give or take, and most people buy gas in terms, and so you're probably paying like $1.50 per term. So the gas company is paying, basically that's $10 or $15 or $20 per million BTUs, and they're buying it for $2 per million BTUs. But the point is, it's at the bottom of this chart. You can see the lower price was over here, and the lowest point was over here in June of 2020. So as COVID was ramping up, then it jumped up, but now we are again at the bottom of this chart. And so why, if you produce electricity from natural gas, why is your price more than 100% up in 3 years when the cost of natural gas at near all-time lows, or at least 10-year lows? And again, guys, this is not adjusted for inflation. These are the actual numbers. So yeah, everything has gotten more expensive, and then the inflation, the new inflation that they report, is on top of the current price, not on top of what was like 5 years ago. And so we're getting screwed. And when the media and the influencers and all the talking heads and YouTubers tell you, oh, inflation is getting better, economy is on fire, well, the people who actually buy stuff and have to work, for them it's not getting better. And so the question is, what do you do about inflation? And so for me, at least, one of the ways that I deal with inflation is investing. And I just made a video last week that everybody should be investing, and it's important to stay in the market as long as possible. But to deal with inflation, one of the ways is to invest into dividend stocks, and specifically dividend stocks that constantly increase their dividend. So maybe right now they barely counteract inflation. For example, here is SCHD, which is a dividend stocks ETF. ETF means exchange traded fund, and basically it's a basket. It's a collection of different dividend paying stocks, and right now they have a forward yield of 3.9%, which is above inflation, at least the official one. Actual yield is probably a little bit less, about 3.5%, because they just had the highest dividend payment ever, and the next dividend will probably be smaller, and this is forward dividend based on the latest amount, okay, and the current share price. Now the share price has gone up a little bit in the last few days, like over here in June it was like 78, and now it's 84, so that's a pretty significant increase, about 10%. But overall, if you look at the price action of this ETF, it's been kind of flat for the last 3-4 years. So ever since the transitory thing came about, CHD didn't move. If anything, for the most part, it actually was below the high over here on January 2022, and it just breached that high, just made an all-time high within the last couple of days. But basically, what you want to look at is the CAGR, or dividend growth, right here. And in the last 10 years, they've been growing their dividend by almost 12% per year. Now, past performance does not guarantee future returns, and this is not a financial advice, but just looking at these numbers, let's take a look at the dividend chart of this ETF. If we look at all times, the first ever payment was almost not even 13 years ago. So that was 12 cents, and then quickly they ramped up to 20 cents. All right, and basically since then their dividend payment has more than quadrupled, but let's call it 4x increase, and that's in 13 years. So the total return on this fund in the last 10 years is almost 200%. That's if you reinvest the dividend, and without dividend reinvesting it's 164%, give or take. Again, that includes current high price, but if you look over here and project the future returns, so if you invest $10,000 into this fund right now and the things remain as they are, so the price growth and the dividend increase, in 10 years the total return, the portfolio value should be around $31,000. So that, I think that's a pretty good return, and you actually end up with more shares. So if you look over here, this breakdown, if you buy today at about $84, you get 119 shares, and that's on the investment of 10,000 bucks. All right, and after 10 years you end up with 188, almost 189 shares. So you, by reinvesting your dividends, you actually increase the number of shares, and each time you have more shares you collect more dividend, because it's dividend per share. And so and if you kind of project that out to 20 or 30 years, let's take a look. So here is our Schwab or SHD dividend calculator, and when you open it, everything preloads the latest price, the latest dividend, annual dividend increase, and let's call it 11.85, because let's call it 11.5 because that's more realistic. But basically after 20 years, if you don't add any money to this fund, you should have around $126,000, almost, and by then you will have collected $53,500 in dividends, and that's just on the initial investment. You don't add any money into your portfolio, and you can see clearly in this table that every year the number of your shares goes up, and from the starting 119 shares you end up in 20 years with 324. But then let's say you add, let's say $250 a month, which most people can afford, just a couple of Starbucks coffees and cigarettes less, and you end up with 1,000 shares at the end of the 20-year period, and by then your annual dividend payment is like almost $23,000, and your portfolio value is about $422,000. Okay, and if you go 30 years, let's say you have plenty of time before your retirement, you end up with over $2.2 million. Your annual dividend payment is $200,000. Like, these are straight line projections. Now if we look back over here, obviously it doesn't always work out that way. The prices of the fund go up and down. You can see with the economy, and even the dividends themselves now, they don't go up and down because of the economy, but basically because of the way of how many shares of each stock they have, and it's actually pretty interesting. So if we have if we look at this page, dividend ETFs, and we look at the CHD, now we haven't updated the number of shares that they hold, but it's about that. Last time we updated was a couple weeks ago, but it's about right. And so basically if you look over here at the holdings of this fund, okay, so the fund holds shares of all of these companies, and at the top we have biggest holdings by market value. So ADIVSE, they had a really crazy run in the last couple of months. They were like $160, and now they're $194, $195, and so basically that's why the price of the fund itself is going up. But these guys, they are raising their dividends also pretty fast. BlackRock, Coca-Cola, all these companies are basically having pretty good. Even MO is at 52-week highs. So all the stocks at the top, you can look at their dividend increases. So you can see ADIVSE, for example, has increased their dividends in the past 10 years by almost 14%. So each year, not only you already get a dividend, so about 3.2% yield, which is comparable to current inflation, but that yield goes up by an average of 14% per year. Now, yeah, lately in the last couple of years, they only raised it by 4.8%, give or take, but still, you can take a look at this, and it's they're raising it every year. Now, the yellow line over here, the red line over here is actually a dividend yield curve, and you can see that it's going down, and the reason for that is because the share price is going up, so you get less of a dividend per the dollar amount invested. But still, they're raising their dividends fast. Soon, in about 3-4 months, they will be raising their dividend again. So they raise it every 4 quarters, every year. And over here, basically, once you go to the CHD holding page, you can click on the company you like, and you can research their financial data. So over here, here's the revenue and the net income, their cash and debt positions, and then EPS, net income, EBITDA. And if you scroll down, you can have shares outstanding. You can see that they haven't really been buying back shares. They're raising the dividends. Here's the breakdown of all their revenues. They have a lot of revenue segments. Basically, it's like different drugs. And here are the projected or estimated returns or revenues and EPS and all of that good jazz. Here are their margins. And so you can look at different companies and see their financial metrics. So here's a chart with EPS and P ratio. And actually BlackRock is, for a bank, it's very expensive. 22 P ratio for a bank is very high. But compared to the rest of S&P 500, it's relatively cheap. And you can see their cash positions, their revenue is growing. In the last 2 years, it's growing by about 5%. Last year, it's up 11.5%. So you can look at all these metrics. And so why would you invest in something like a CHD? Now, this is not an ad for a CHD, but if you don't want to do any of this research, let's say a lot of people, they just, not lazy, but they just don't understand this. They don't want to deal with this. And so basically what the CHD does, they have like their own criteria of including of which companies to include into this index. I won't go into details, but they try to pick decent companies. They have a couple of questionable companies in my opinion, but they have high dividend payers. And so even Altria, a cigarette company, now I'm not a big fan of this stock anymore. I was a fan of this stock when I was like over here in the 40s. I actually made a video that I sold some of my shares in Altria, and since then they've gone up by like $4. I sold at $49.50. But I invested in Palantir, and I'll do a separate video on Palantir. But basically, Altria, in my opinion, is way overpriced right now. People are just like, dumping money into it for some reason. And their yield, when I was buying it, the yield was like 10%. Now it's 7.5%, give or take. So that's a huge drop. And basically, the way I look at it, I was buying it at $40 over here, and the dividend payment was the same. And so from here, from 40 to 54, that's 14 quarters of dividend that you leaving on the table. That's how I look at it. Like, why weren't people buying here in April? Let's zoom in on this price chart. Let's go 1 year. So why weren't people buying here for $40.75 or over here below $40? That was just 5-6 months ago, guys. Why are people buying now all of a sudden? What's changed? In a most particular case, I don't think anything has changed. Their revenues are declining, and we can see it over here. So I think this is an amazing chart for that. You can see year-over-year revenue, 5.28 billion. So this is Q2. We compare it to Q2 over here. It's down. Compare Q1, which is the lowest quarter every year, pretty much. So 472 versus 4.76. Okay, it's down. And this year is down from this Q1, 476, 482, and it's down from 21. So, and even if you read their earnings report, they clearly state in the report that their smokable revenue is down 10.5% year on year. So from a year ago, the amount of money they collect from the cigarettes sales, not other products, not like smokeless, chewing tobacco, but from cigarette sales, and that's their biggest chunk. If we look over here at the breakdown, so we see that smokable products are about 85% of their revenue, and basically, or let's call it 80% of the revenue, but it's decreasing by 10% per year on average. And even if they raise prices, I don't think they will be able to keep up the dwindling amount of sales will not keep up with the price increases. Like, you can only increase prices so long, people will just quit smoking at some point. And the number of smokers is dwindling, and people will switch to cheaper brands. Now, the best-selling cigarette brand in America is Marlboro. I think they have like 70% market, and that's a Altria brand. But people will just start switching to cheaper cigarettes. Now, this video is not to pick on Altria, but I mean, it's not a bad stock because ACHD actually owns it at a pretty decent valuation. But the price of ACHD is comprised of prices of all of these underlying holdings. Okay, so if you buy it today, you kind of paying high price for AbbVie. Look at the AbbVie price chart. Like, I was buying it for $1.38 right over here. I mean, I was buying it over here also and selling, and then getting a sign, but whatever. But now it's like almost $200. I bought it less than a year ago for $138. Now, good company. Not saying anything bad about it, but a little bit overpriced. But the point is, if you don't want to research these companies, if you don't want to look at their metrics, SHD is a pretty decent fund with relatively good yield. you know, and I think it's still kind of underpriced because look, price chart doesn't lie. It's kind of been flat for the last 3 years, whereas the dividend is actually going up. So today you're getting better yield than you did in the beginning of or in 2021. You're getting under 3% yield, and now you're getting almost 4%. So if you don't want to do research, I think this is a good fund that will beat inflation. Again, not a financial advice, but I think it's a decent fund, decent long-term investment that pays nice dividend. And then if we look back to this calculation, after like 5 years, your actual yield, if you invest 10 grand today, will become 6.16% if it continues to increase at the same rate as it has been. And so that's way above the current inflation. And by the time 30 years go by, it's going to be 200%. And if you look over here, we actually have this bar called investor. So if you put 10 grand right now, and for 30 years you put $250 each year into the fund, your total investment after 30 years will be $100,000, and the value of your investment will be over $2 million. Again, assuming that these numbers hold up, that the price increase and the dividend increase kind of stay in the same range. Again, it's going to go up and down, but with dividend reinvestment, you get this dividend snowball effect. All right, guys, thank you for watching. I took it a little bit further than I wanted, but you know, with the inflation running crazy, I think the best thing we can do is to create an investment portfolio. Do it as early as possible. Now, I am not advocating investing in risky stocks or taking financial risks, but even something like a CHD, slow and steady, keep adding like, I don't know, $50 a month to it. Invest $100 today and put $50 a month. You can do it. Most people can do it, even if you work minimum wage. You know, you cut one Starbucks a week from your or like you go from five Starbucks coffees to 3 per week, and you will be able to scrape $50, put it into your future, and trust me, after 10-20 years, you'll thank yourself for doing that, because it's like, even with minimum wage, you don't really notice $50. Most people won't, and at the same time, it will accumulate and it will compound. And you can see here, like it starts slow, but then it starts growing exponentially. And this is the power of compounding. And even I'll show you. You invest $100 today, and then you add $50 per month to this portfolio. Okay. After 30 years, your total investment will be $18,000, but it's basically less than $1,000 per year. It's like $600 per year that you invest, but you will end up with $320,000, give or take, after 30 years, and you will have collected 160,000 dividends. So by just investing $100 today, and every month you put in $50, almost anybody can do that. Guys, you'll thank yourself for investing, and that fights the inflation and creates a portfolio for you to basically live off, to provide supplemental income. Like, it will be paying you $30,000 a year in dividends after 30 years. So, okay, guys, thank you for watching. If you enjoyed this video, please smash that like button. It really helps the YouTube algorithm. Subscribe to the channel, come back for more videos, and I'll see you in the next